This is a webinar about buying a business. I am the Center Director of the Small Business Development Center, hosted at Coastal Enterprises, which is a lot. Obviously, I've just bumbled my way through it, so it's a lot to wrap your mind around. Essentially, what we are, most importantly, is we're a free and confidential business advising service for you. There are 12 of us throughout the state. It is our full-time job, and we're here to support you. So about half of our clients typically are pre-launch, considering entering a business, buying a business, as is the case with this webinar, and the other half of our clients are existing businesses. So people thinking about hiring their first employee, adding a second location, revisiting their pricing, or, another webinar I'm going to cover in a couple months, exiting the business and planning on exiting. So we cover the whole business life cycle. We love doing it. It's what we're here for. If you have questions throughout this webinar, first, I'd invite you to take yourself off of mute, interrupt me, and ask. We keep these webinars intentionally small so that we have the opportunity to engage and address questions as they arise. But secondly, if you're worried about confidentiality or you have a specific question you really want to dive into, I'd invite you to reach out to either me or, request an advisor and be assigned to one at the state level. We're geographic based primarily, but we are cross-trained and we're here for you. So we love, the brunt of our service, the most of our workload is really in that one-on-one advising. That's kind of where we thrive. So I do these things to kind of get some information out there and give you the information you need as a foundation. But when we get to roll up our sleeves and really dive into a project, I think that's fun for everybody. So a lot to cover today. We're going to go through it, but a couple quick things. Just keep yourselves on mute unless you have a question, in which case, please interrupt me, ask, and let's engage and talk about it. We are recording this, and you'll get the recording of the webinar afterward, as well as the whole slideshow and my contact information. So try to get you as much information as possible so you can review the information, rewatch the webinar, take a look at the slide deck if you missed a slide as you go through it. So don't worry about taking notes. You'll get all that information going forward. What we're going to talk about today, right? This is kind of my bread and butter. A little bit of background about myself. I am a certified business appraiser through the International Society of Business Appraisers. I've done about 150 broker price opinions of value or valuations. So I've represented buyer side, seller side, helped both negotiate and reach a transaction period. I've been a broker in the past. I left that world to kind of enter the technical advising field probably about 5 years ago, but I still do some valuation work on the side. What I'm talking about today is really the buyer side. So if you're coming into the business, either a business in mind that you may work at or you may be aware of, or if you're just kind of thinking about being an entrepreneur, owning your own business, and not sure what that looks like, great, you're in the right spot, right? So we're going to talk about why buy a business versus starting your own, talk about identifying what it is that you're buying, talk a little bit about the valuation process and understanding what it is worth, the asset purchase and how you come to a reasonable purchase price. And then structuring the deal and kind of best practices about going through the actual transition period. So why buy, right? And if you're thinking about buying a business, you're going to be an entrepreneur, but it's kind of a shortcut approach, right? You get to inherit the business as it's currently running. So maybe you're tired of working for other people. You want to do it for yourself. You want to see if, you can sit behind the driver's wheel and drive the car better than the person before you has. But you're nervous about starting from scratch, right? If you think about writing a business plan, a lot of those assumptions that you're trying to justify, the market research, the understanding the customer, when you buy a business, those assumptions are answered, right? You've established a foundation, you've identified the market, you've identified the correct price point, and you get to kind of play in the market, the margins, right? So it's a safety blanket of sorts where you understand, hey, what I'm buying is a functional vehicle, right? I can drive it. And what I can do is make it drive a little better. Or maybe I bring something to the table that can improve upon what the current owner has done. So you get that proof of concept, right? There's a lot of safety to that and security. A lot of information on this slide, but I think what is really important is to identify where you and the seller meet, right? What is your relationship with the seller? Because the crux of this transaction is the negotiation between two people, buyer and the seller, and understanding how those pieces fit together. Where we're going to focus on is kind of the first two columns here, right? So the staff family is essentially, okay, I am a staff member of this company, and the current owner has approached me and said, I'm planning on retiring, I'm planning on moving on. You're a key employee, I'd like you to step in. Same thing with family, right? Maybe it's a father or a mother who owns the business now, they're looking to retire and you're stepping in. The other opportunity here is where you're replacing the seller, right? In both of those situations, essentially what you're buying is a job. You're saying, okay, I want the security of being my own boss, being there 40, 50, 60 hours a week, running this business myself and paying myself through the business, right? Usually, the way that that is purchased, where you're buying a job, you're buying an existing business, and you're plugging yourself into where the current seller is, requires some debt, right? Unless you're coming to the table with an empty checkbook and you're ready to write that check, you're going to either work with a bank or work with a seller to figure out a way to structure the debt, right? And we'll talk about purchase price, we'll talk about structure, but it's paid for by the cash flow of the existing business, right? And that's a real key piece to say, okay, how much cash is this business generating above and beyond operating costs? And what is left over to support the debt that I am potentially creating in this purchase? The difference between that and a synergistic buyer, right? The synergistic buyer being, I am already in business, and I'm buying a vertical integrated company or a horizontally integrated company, a competitor, and acquiring that and merging it with my existing business, right? Because in that case, what you're really looking at is the cash flow generated by both businesses, the pro forma cash flow with the synergistic opportunities provided by that. We're not going to spend a lot of time looking at that. We're really focused on these first two columns. The advantages of buying it as a staff or family member position. If you're an employee there, you already know the ins and outs. You already know how to deal with the customers. You know who the vendors are. You know who the landlord is if it's a leased space, right? You have those relationships and that intimate knowledge of the business. It's a very easy transaction. If you're replacing the seller, if you're not employed there yet and you're stepping in to replace them, there's a wide range of kind of negotiating options about how to structure it. And we'll dig into that a little bit. Now, the disadvantage for either of those is that it's really limited by the existing cash flow of the business. The existing cash flow being what is demonstrated and the historic ability of the business to support debt. If you're a synergistic buyer and you're making the argument that, hey, my existing company and the company I'm buying, 1 + 1 is 3, okay, you have to justify that and explain it, but there's an upside to it. There's an opportunity, right? Now, you can make the claim, you can make the statement that your involvement in the company going forward, if you're replacing the seller, will create growth, right? But that requires confidence in yourself. And then there's a distinction, right? Are you paying for the company for what it's going to be, or are you paying for what it is? Paying for and buying are two different things, right? I want to buy what it's going to be. That's the opportunity that I'm going to realize. I want to pay for what it is, right? I'm paying for what it's been to date, and everything that I bring to the table, everything that I improve of this business is mine, right? That's my sweat equity that I'm going to create. So what are you actually buying in these first two columns, right? I'm a staff member of an existing company. I'm a family member, or, it's a small mom and pop shop. It's a small enterprise, 5, 10, 15 employees, and I'm replacing the CEO, right? I'm going to step in as the owner, run it 40, 50, 60 hours a week. What you are buying is the ability of the assets, the existing assets of the business, to reliably generate future cash flow. A lot of parts to this, but the distinction between, okay, it's an asset list. Sure, I'm buying the company, the goodwill. We'll talk about that. It's cash flow. What can the cash support, right? Assets are two things. A lot of people freeze at that thing. Oh, it's not an asset sale. I'm buying the company. I'm buying the reputation. I'm buying, the customer list. Assets are two parts. There's tangible assets. That's what people think of when they think asset sale, right? Furniture, fixtures, equipment, inventory. You walk through the shop and you can pick something up and touch it. That's a tangible asset, really. Intangible assets are still assets, right? That's the name, the reputation, the website, social media accounts, historic customer information, historic financial information, right? Being able to buy the books and review where the cash has gone and come through, right? The phone number, right? Does the phone ring 30 times a day with new customers calling, and there's value in that phone, right? A catch here, right? So one of the things that gets talked about a lot, oh, I'm buying a business, I'm buying the ownership of the business, right? That's what a lot of business owners think of that they're buying, because they want those intangible assets. They think, to buy that, I have to buy stock. I have to buy 100% of ownership of the stock of the business. It can't be an asset sale, and asset sales for liquidation, right? Wrong, right? So the distinction between an asset sale and a stock sale is essentially who is buying the company and what are they buying. A stock sale is when you buy ownership of the existing LLC, C corporation, B corporation, right? You are buying the owner's ownership and you're stepping in. The downside to that is that the company stays exactly the same. All of the liabilities stay on the books, right? So if you're buying stock, understand not only the assets you are purchasing, but is there a credit card that's past due? Do they have a working line of credit that is extended? What do they owe their vendors, right? All of those liabilities stay with the company. An asset sale is probably 95% of the transactions that I see for the small, Main Street businesses, less than 1.5, less than, I call 5 million in revenue, right? It's really an asset sale, and it's tangible and intangible. But an asset sale is, I'm a new company. I'm going to file for an LLC, pay the $175 with the state, get that back. And that LLC is buying all of the tangible and intangible assets of the old company. And it's just the asset list. So I'm going to go through and list all of the tangible assets I want. I'm going to set a benchmark for inventory that I want on the shelves when I buy it. And all of the intangible assets. I want social media account information. I want the historic financial information to stay with the business. I want vendor relationships that can be assigned to me. I want employees, if there are employee contracts, whatever it is that is a transferable asset, I'm going to list it in my asset purchase. And on day one of the business, it's a brand new business. But if I've structured it correctly and transferred both tangible and intangible assets, the customer doesn't know the difference, right? And that's key. I want the same phone number to ring and the customer to talk to the same employee and order the same thing that they ordered yesterday. I just want it to be for me in my new company. It's cleaner, it's simpler, and you don't get any of the liabilities of the old company. Now, the downside to that is licensing and permitting doesn't transfer sometimes, right? And if the intangible assets aren't transferable but are still valuable, right? So things to consider, like accounts receivable. Is there a lot of AR that is out, and who's collecting that? Does that stay with the old company, and is the seller responsible to go collect that? Or is that part of the asset that you're purchasing and you get to collect that for your working capital in the first couple of weeks that you're running the business? Same thing with vendors, right? If you're looking at that business and you're talking about buying it, and there's a lot of accounts payable out there, and those vendors, are people that you want to work with on day one and want, to be in good standing with, they might not care that the business sold. They just care that that business owes them money. So is that the seller's responsibility and you're trusting the seller to make good on their promise? Or are you taking on that debt, that vendor debt, and making sure you honor that on the day of close? Work in progress is another big one, right? Construction, any kind of, manufacturing. who owns that work in progress? Who's responsible for making good on the contracts that the old company signed, right? If a house is half built and the business is sold, and the day before the close, the independent contractor, sent a bill over or did a bunch of work and is owed money, just make sure that the seller understands their obligations and you understand your obligations and what you're buying. And a good purchase and sale agreement covers all of these things and sets those benchmarks, but it's just something to be keeping in mind as you approach that. Big key here, right? Transferable assets are buyable assets. If you're paying for something that is an intangible asset, you want to know that it can be transferred to you, right? Those policies, those procedures, that human resources manual, that's great. If they have standard operating procedures for everything that they do, that is a transferable asset. You can pay for it and you can get it on the day of close and you can use it on day one. If that standard operating procedure is just, it's whatever the seller has always done and the seller is the business, that's not a transferable asset. It's valuable, right? It's helping the business run. It's a key part of the business. But if the seller disappears on the first day that you own it, that knowledge is gone, right? So maybe some of that transferable asset is tied to part of the purchase price where you build it in and you say, yeah, I'm going to hold some of this in reserve, or I'm going to structure part of this purchase price as an employee agreement to keep you on staff for a period of time, or an independent contractor agreement where you get paid after I purchase it for transferring those assets, teaching me how to do this, right? So what are the assets that you are actually buying, and can you buy them? Can you purchase them and have them tangible? Do they become tangible instead of intangible? Great question to ask. I throw this at the bottom of this slide, right? When was the last time you took a vacation? If the seller says, oh, I haven't taken a vacation in 20 years, red flag, right? Because they can't be trusted to leave the business. They can't trust the business to be left, right? If they are the business, they're there every single day. It probably means that that knowledge that they have, as wonderful as it is to create what they've created, isn't transferable, right? It's not written down. It's not in a policy manual somewhere. It's not in an SOP. The employees need somebody to have that, to be monitoring them and watching over them. If the seller says, yeah, my wife and I went to Aruba, or my husband and I went to Aruba, last April for 3 weeks, it was great. And you have a great conversation about Aruba and your experience in Aruba. Good, right? Wonderful. They can step away. They can take their eye off the business, and the business runs itself, at least for a period of time, at least for a week, right? So it's a great way to get some insight as to what the seller has done to prepare for the business to be sold. So what is goodwill, right? A lot of people equate goodwill to their input as a seller. What have I invested in the business? Favorite conversation I had, not favorite, but telling conversation I had with a seller a long time ago. I said, what is this business worth to you? What do you think it's worth? 2 heart attacks and a divorce was his answer, right? That's what he had invested in the business. It's a value, right, in the perception of the seller. But all that work, all of that effort for you as a buyer has to create excess cash flow, right? They can have a great reputation. They can have a phone number that rings off the hook constantly. They can have great key employees, 500, Google reviews that are 5 stars. But if they are breaking even, then they are not leveraging those intangible values to create excess cash flow. So a key part of that is essentially, what is cash flow? How do you measure it as a buyer, and how do you look at it? First thing, right? It has to be legal and it has to be demonstrable. And this is for you as a buyer, but more importantly, it's for your funding sources, right? So if a seller comes in and they're driving a Mercedes, and that they have 2 homes in Florida and South Carolina, and their business is break even, and they say, well, yeah, of course it's break even. half my clients pay in cash. And it's like this nudge and wink. Great, right? I'm not part of the IRS. I don't particularly care. They haven't paid taxes in 15 years. It is what it is. But you can't show that to a bank and get any kind of loan, right? You can't trust, is it actually half the clients or is it 20% of clients that are paying by cash? If they're showing $1 million in revenue on the books and they're saying, oh, it's definitely 2 million, how do you know that, right? Are you willing to trust them? So first thing, cash flow has to be legal. It has to be demonstrable. If they have internal books that they're showing you, how does that compare to their tax returns? Has an accountant reviewed it and signed off on it? If there's huge discrepancies in those two things, always use the tax returns, right? The tax returns are what an accountant has put their name on and submitted. And the accountants have some liability. It's not a lot with their insurances, but they've at least reviewed it. So always ask for tax returns. Use that cash flow as a basis for understanding what is available to you. Historic consistency is another part here, right? It's a little touch and go in the last couple of years. There have been a lot of conversations around COVID and how to treat 2020 and 2021. Do you throw it out entirely? Do you weight it? Do you give it consideration? I think there's value to it, right? Because you have to at least look at it and understand how well did the seller react and how much have they recovered to pre-COVID levels, right? If it dropped and stayed low, and they're trying to sell it based on what the business was in 2019 or 2018, it's not there anymore. The world has changed, right? And if they haven't adapted, then you're buying tangible assets and that's it. Now, if you're looking at that and it's dropped and then came back and, 2022, 2023 is as strong as 2019, all right, maybe we look at 2020 and we just throw it out. Yeah, that was a tough year. We lost some money. We got PPP or EIDL or some of the government subsidies. But you know what? It's not pertinent because it was a one-off. It was something that hit a lot of businesses and we're back better than we ever were before, right? Great. Let's look at most recent information. So just to run through what we're looking at, right? So the income statement's really what the focus is for this. And I know this isn't a finance course, but so much of what you're buying is about the ability of the assets to create cash flow. Right? And cash flow is on the income statement, the operating performance, right? This is what the business does. And it's really three pieces. You're looking at revenue, which is sales, right? How much is created in sales? How much do customers pay this business? Usually it's over a year. If you're looking at a tax return, it's year by year, or you can request to look monthly to see what the seasonality is, right? When are customers paying for this service or this product? Expenses are two pieces that are really key, right? One is called direct costs or cost of goods sold, COGS, right? This is how it's usually said. And that is direct to the sales. Essentially, what do you spend to replace what you are selling? If you're a service business, it might be zero, right? You don't have any cost of goods at all. But manufacturing, restaurants, you're thinking ingredients, raw materials, right? 2x4s, whatever it is, direct costs. The more I sell, the more I have to spend. So we look at cost of goods as a percent of revenue. We will say, okay, of every dollar I sell something for, 30 cents goes out the door for ingredients. 30 cents goes out the door for 2x4s, whatever it is. The more I sell, the more I spend. And so last year was 30 cents, 30% of revenue. The year before was 30% of revenue. Great. That's consistent. It's called a like-kind statement. Essentially, I can say, doesn't matter if my sales went up or down, am I managing my costs effectively? And gross profit's a great number to look at. It's essentially the value add. It's the difference between your sale price and your cost of goods, what you're left with. If I'm paying 30 cents of every dollar for ingredients, I'm keeping 70 cents of every dollar for myself. Good, right? That's the value created in the business. The value that the business takes raw ingredients, raw materials, whatever it is, and sells it for something more than they bought it for. So that gross profit line is a great way to look at a business and see what value they are creating, how they're, communicating that value with their customer base. The second piece of expenses is overhead, fixed. indirect expense, right? And it just is what it is. That's your insurance. That's your rent, your utilities. It doesn't matter how much I sell, my insurance is what it is, right? Doesn't matter how much I sell, I still have to pay rent. So we look at that as a dollar amount, $900 a month for insurance. And so when we're looking at historic consistency, we usually try to get 2 to 3 years of tax returns, and we look at them next to each other and we say, okay, what are sales doing? Okay, sales are going up. I love that. What's my cost of goods margin as a percent of revenue? It stayed steady year to year. Great. They're controlling their costs well. They're controlling their pricing well. What's my overhead amount? Right. Okay, it's staying fixed as well. Great. They're shopping their insurance when their insurance goes up, or their utilities are going up every year. Guess what? We're not going to be able to fix that, right? That's what it is. Then you get to this last piece, net income, right? Net income, little bottom piece at the end of the day. That is how profitable the company is. That is the taxable piece of information that you're looking for. And it's what you have left to support your balance sheet, right? So revenue, talked about revenue, cost of goods. I'll send you these slides so you can look through it if you have questions on it. But this is the whole point of the business, right? To maximize the revenue, maximize the sales, control your cost of goods as a percent of revenue, the value you're creating to create gross profit. And then what do you have left to support your overhead? And that little blue piece at the end of the day, your net income, right? Once you lay it out year to year, it's relatively simple. It sounds complex, but if you're working with a purchase and sale agreement, you're working with a buyer or a seller, they should have that information readily accessible for you. And you're looking for a couple of things, right? What are the trends? Because you think about it, the law of inertia, right? What's in motion or arrest stays in motion or arrest unless acted on by an outside force. So what are those trends that you recognize? Is revenue going up every year? Is it stagnant? Is it coming down, right? Cost of goods, are they controlling their costs? Is that ticking up and you have to revisit pricing? It's two things, right? One, how closely are they monitoring their own business? How well if you buy a car and they haven't changed the oil in 4 years, that's a red flag, right? Same thing with this. If you're buying this business, you're looking at it, you're looking under the hood and you're saying, okay, they're controlling their costs. They understand how to price their product. They've got a good sense of how to run this business. You can see a lot about how a business is run by the state of the financials. What's the continuity in the trends? Is it consistent? Are there large jumps, right? Unknown accounts. Miscellaneous, big red flag, right? If 10% of their revenue is in some miscellaneous account that is unexplained, what's going on there? They're just not keeping their books. They're not paying attention, right? So the balance sheet's the second financial statement, and that's essentially what you are creating with an asset purchase. The balance sheet is what the business is. It's usually ignored. It's very important at the beginning of the business, at the end. But it's three things, right? And you think of it kind of like a house: assets, liabilities, equity. So assets, that's tangible and intangible, right? That's what you're buying. So you look at that and you say, okay, here's my purchase price, and it's divided up amongst these assets. And you can pay for those assets one of two ways. You can take out debt, liabilities, or you can invest equity, personal equity, right? And liabilities and equity are always equal to assets. That's great because it kind of predicts what the structure is based on your purchase price and what you have to borrow and what you can invest. More importantly, right, you flip back to this net income. Great, I'm running my business, it's doing well, or I'm looking at this historic information. They've got a good, strong net income. It's the assets are generating excess revenue. That's what that tells me, right? I'm using my assets, generating revenue, covering my operating costs, and I have something left over. What can I do with that? Pay taxes. That's what the IRS wants you to do. Then you can do one of three things. You can go out and buy new assets. You can pay down liabilities. That's a critical piece of this conversation because that liability is created in the purchase price. So when you're talking about what value does this have, it is what value does that blue piece support? Right? How much liability can I create and support with my little net income every year? before I'm underwater, before I'm losing money. And then the third piece, equity, right? My assets are in a good place. I don't have any liabilities left. I've paid off all my debt. I get to keep it. I am the equity, right? The benefit of a buyer that we talked about at the beginning, that's the dream, right? My business is in a good place. It's cranking on all cylinders. I've got some net income left over. What do I get to do with it? Keep it, right? Great. So how do you look at cash flow? Two things, right? So EBITDA is a term thrown around a lot. It's equity, net income, before interest, taxes, depreciation, amortization, right? Depreciation, amortization, non-cash expenses that might fall in this little red piece, okay? So if you see that, it's essentially a tax benefit that someone has had from purchasing a business, purchasing assets. So you can add that back because it's non-cash. And what we're trying to figure out is, okay, the net income's a starting place. How much cash is actually in this business? And a lot of sellers, you know, and business owners in general, put things that are legal and they are demonstrable in this overhead category, right? And they are things that are called seller's discretionary earnings, right? Seller's discretionary. And what seller's discretionary is essentially things that can be taken and expensed through the business legally. You always talk to an accountant about it, but might not be expenses that you, the buyer, would necessarily incur. A company vehicle, high education costs, training and education, cell phone, right? Health insurance, 401k match, right? These are all things that are benefits to the seller, could be benefits to you, or you could choose to take it as, you know, salary, or you could choose to take it and pay back the business loan with it, right? So the difference between SDE, seller's discretionary earnings, which is one form of cash flow, and EBITDA is those two pieces, the salary, the seller's salary, and the seller's discretionary earnings. Now, the seller often wants to show SDE be as high as possible, right? So review that carefully and say, okay, is that really a discretionary expense, or is it necessary for the business to remain in operation? So something that I've seen in the past is like a seller saying, well, we offer a 401k match for all of our employees, and that's 80 grand a year, so we're adding that back. And we pushed back on that. I was on the buyer side at that time. And I said, well, if you took that away from the employees, how many employees would you have left, right? It's an operating cost. That's something that you're using to incentivize your employees, keep everything running smoothly. Today's labor market's very tight. We're not willing to add that back to cash flow because we have to keep it to keep these employees happy and satisfied, right? So look at that. If they're saying, hey, it's $200,000 a year in SDE, okay, what does that look like? Is it legal? Is it demonstrable? And is it truly discretionary? And we talked about this. Relationship, you can increase your assets, buy new assets. So debt and equity, right? So you have to be able to pay back whatever debt you're creating. So when you're looking at this and they say, okay, $200,000 in SDE, figure it out, right? Okay, it's this much in net income. Okay, they bought some assets a few years ago, so they have high depreciation. We're going to add that back. It's just a way of reducing their taxes. They take this much in salary, and then they have these couple of things that they added back in discretionary spending. We don't necessarily agree to, you know, we don't disagree with any of those. We're going to keep it. So if that's their SDE, and we look at that, and we look historically, we say, okay, SDE is consistent through the years. We're happy with this number. What are we buying? Essentially, it's two things. You're buying the assets, right? And you're using equity and liabilities to do that. So if you have what you need out of it, I'm buying a job. I'm going to leave my work over here and go work for this company I'm purchasing. Then I know roughly what my needs are for salary. That's non-negotiable as a buyer. It should be non-negotiable, right? I'm not buying a hobby. I'm buying a job. I got to be able to pay myself. So start with that. And you think, okay, if I'm buying $200,000 in cash flow in SDE, and I need to pay myself $100,000, Great, I've got $100,000 left to support debt. Hold on, right? So if you're borrowing money and you need $100,000 to pay for $100,000 in debt, principal and interest, what happens if, I don't know, you back your work truck into a telephone? What happens if the fryolator breaks and has to be replaced, right? So whether or not that debt is commercial, seller, friends, family, fools, wherever that money's coming from, there's a buffer that's built in, usually 20 to 25%, called debt coverage ratio, essentially where they say, okay, there's $100,000. We're going to lend you an equivalent debt to support $80,000 of debt, 75,000, 20% buffer, assuming something happens. Something always happens. We've already talked about our salary needs. You can't get blood from a stone, right? So if you don't build in that buffer, you're fully leveraged, something happens. Where's that coming out of? The only other place that it can come out of is your salary, right? You're going to pay for that out of your own pocket. So regardless of where the debt is, if you're unwilling to put your salary on the chopping block, and you should be, right? It's a lot of work for probably not much pay. You put a buffer in there. Make sure you're accounting for some unknown, some risk. So that's what you're buying. That's how you use the SD to calculate, what do I have to support debt, right? So what's that cash flow worth, right? So I'm looking at that. I'm going, okay, so it can support debt. How do I figure out value from that? Three things that I throw out there, right? So the floor value is essentially, okay, I'm going to buy these tangible assets at auction. I don't see any goodwill value here. It's inconsistent over the years. Sometimes the owner takes salary out, sometimes they don't. Revenue's been all over the place. I'm unhappy. I'm just going to make an offer based on the physical assets, and I'm going to basically start this from scratch. I get to buy them all at once. Maybe an employee or two stay on. I'll keep the sign up. People expect a restaurant. They'll find a restaurant. It is what it is. Market price is in the middle, right? That's the kind of the value in the market where you say, okay, this supports something more than just the physical assets, right? If I'm looking at that ability to support debt, and hey, guess what? It supports a value of $500,000, and there's $300,000 in physical assets, but it supports a higher rate. What does that tell me? There's goodwill value there, right? What that tells me is that they're using their assets to create excess cash flow. Goodwill is that calculation of purchase price minus physical assets. Right? So if I say, okay, you think it's worth $500,000, I think it's worth $500,000, it can support $500,000, I'm going to pay you $500,000, $300,000 of it will go toward the truck and the furniture and the equipment and some inventory. And you know what? $200,000 of that is intangible. We usually don't itemize intangible value for small business transactions under $1 million, under 1.5 million. But it's intangible. It's the goodwill, it's the name, the reputation. You don't say, okay, reputation is worth $25,000. Phone number is worth $17,000. It's all intangible, right? And it's just the difference between the market price and the tangible assets. Everything else is intangible. It's called goodwill. So if you and the seller agree on a price that is somewhere in the middle of there, that is market value. Now you could go elsewhere. You could go down the street and buy a different restaurant. You could buy a different business. And the market price is essentially just what a buyer and a seller agree upon. There are rules of thumb, and we'll talk about that in a moment. Ceiling is the buyer's alternative. That's your alternative, right? This is as high as you're willing to pay before you think to yourself, you know what? I pay $500,000 for this business. It doesn't really cash flow. I'm essentially starting over. And if I'm starting over, I can buy these same assets for $300,000. I can put $5,000 or $10,000 into a bank account and working capital and lease a space down the street and put this guy out of business. And I'll still have $185,000 more than I expected. So why the heck am I going to pay $500,000 when my alternative is to start from scratch, use my local SBDC to make sure I'm doing it correctly, and compete, right? Be a competitor in the market. So ceiling it for you is, what does it cost for you to go and do this from scratch? Floor is just the asset value, right? The seller is expecting at least the tangible asset value. Market is where you and the seller agree on a price somewhere in the middle. We talked about this. You buy what it's going to be, but you pay for what it is. If you're a contract renovator and you're buying homes and flipping them and selling them, you do not pay for what you're going to sell it for, right? You do not pay for your investment and your ability to make that home livable again. You pay for what it is, a beat up old home on the market, right? Your investment, you get to keep that. That is your work that you're recognizing. Now, sellers, always see the opportunity. And that's why they're entrepreneurs. So they say, hey, it's been a tough couple of years. I'm tired. Here's everything you can do with it. Great. That's why I want to buy it. But if I pay for what it's going to be, I'm underwater until it reaches that point. I'm overpaying. And even then, sure, I dig my way back out. And then everything I've done is just gets it to break even. So if the seller is telling you about all these opportunities that are out there, keep them right on file. But if they're that great, why hasn't the seller done it? Right? Simple as that. So pay for what it is. Use the historic tax information to justify the purchase price. Otherwise, you end up in this situation, right? So you've got your historic SDE, ability to support debt. We talk to a bank, we talk to a couple of lenders, we figure out what is the term length that they're willing to offer, what kind of interest rate. You've got your down payment. That gets us to a supportable purchase price. At this purchase price, I can sleep at night, right? I know I'll be able to cover my debt. I've taken into account my salary. I've made it work. If the seller still isn't able to come to that point, right? If they're saying, hey, you're offering me $500,000, I'm not going to go below 575. It's possible, right? And I don't want to disparage that. Maybe you bring something to the table, but your principal and interest payments are going to be coming out of your pocket or out of your salary until SDE reaches the ability to support that, right? So the question then becomes, it's unsupportable by commercial debt. The bank's not going to lend to it if it's a projection. They're only going to lend to the historic. So the seller is going to have to remain involved in some way. It burdens the business. And are you confident enough in what you bring to the table that you can get there quickly? As quickly as possible. Because the longer you wait, the more money is coming out of your pocket. So if you're looking at this business and you're like, they have no social media presence, they have no marketing, and I can, I have an MBA in marketing and I can bring that to the table and my strengths fit in with their weaknesses and we're going to, take it from here to there really quickly. Great, right? You can over leverage it a little bit. You can say, I'm going to pay a little bit more for this because I bring it to the table. But if you're looking at it and you're like, processes are in place, SOPs in place, they've done great, this business is running like a top, it's worth a lot, but I can't do much to it other than continue running it. That makes me nervous, even though it looks really good. If you're over leveraging it, that last 5% is going to be a real uphill battle, right? What about multiples, right? People throw around multiples a lot. It's a good starting point. And multiples are usually one of two things, right? They're either gross income, sales, or SDE, seller's discretionary earnings cash flow, right? A lot of businesses love using top line multiples. They say, hey, I talked to my accountant, it's 1.5 times sales. I did $1 million in sales last year. My business is worth 1.5 million. Oh, okay, that could make sense. Look at the bottom line, right? Does the business support $1.5 million in debt if you're to borrow money to pay for it? Maybe it does, right? Maybe net income is really strong. Maybe SDE is really strong. What's more common is that the business owner sticks to that multiple because it's better than the other multiple. and the business is barely breaking even, right? The type of multiple is usually determined by you, the buyer. A top line multiple is only valuable when someone is buying what it reflects, right? The top line, the sales, reflect market share. They reflect number of customers. So typically when somebody buys it based on top line, there is synergistic business. They're saying, I don't worry about any of the expenses. I have my own payroll. I have my own legal and professional. I have my own insurance. I have everything in place. I just want the footprint. So I'm willing to pay a little bit more. So top line multiples are usually higher because the buyer that's driving it has a synergistic approach and is buying a book of business. Right? This is common in accounting practices, legal practices. Competitors sometimes use this. Bottom line multiple is much more common for a small business because everything remains the same through the expenses. And what the buyer is really focused on is what is left for me to support debt. So use the bottom line multiple if you're going to use anything based on the conversation around what we're having, the staff, the family member, the buyer buying a job. They're keeping the expenses in place. They're keeping the sales in place. They're focused on the strength of the business, not the size. Right? And then, there's so much more that goes into the negotiation. So that might give you a ballpark, but then it's a question of, okay, what is discretionary? We talked about that. Is inventory included or not? How old is the equipment versus how new? Does it have to be replaced in the next year or two? Are those intangible assets transferable, or are they all just seller knowledge? Right? Structuring the deal, I want to talk about this a little bit. This is an important part, right? Obviously, okay, we've agreed upon a price. How do we figure it out? Commercial lender looks at collateral and physical assets. They like to be protected. So most banks will only look at tangible assets. They may lend to intangible assets with like an SBA guarantee, or if you have significant assets of your own that you're willing to pledge. A seller note is more and more common, where the seller stays involved in kind of a secondary position behind a primary lender, or just as the seller, right? And essentially what a seller note is the seller acts like a bank. They stay involved and they say, pay me over time. The benefit of a seller note is that it does not have the same kind of, underwriting requirements of a commercial lender. So a seller might be willing to take some of the risk. And as a buyer, I encourage you to ask, right? What that looks like typically is saying, okay, you think this business is worth 500? I think it's worth 500. But it's a service business. There's not much equipment. There's no real tangible values. I'll pay you 500,000 by paying you 10% of sales for 7 years, or 500,000, whichever comes first. Right? That whichever comes first is the risk factor that you're pushing onto them. This is also very effective if you believe there is excess cash flow, but it's not shown in the historic, right? Like that. Cash business example, right? You're saying, yeah, I think it's there. You think it's there. I'm never going to be able to finance this with a bank. So if we both think it's there, let's tie it to sales. If you're promising me that it's worth, that you do 2 million in sales a year, great. That works for me. I'll pay you a percentage of revenue going forward, so long as revenue's over 1 million or over 1.5 million. Everything over 1.5 million, I'll give you 20% off, right? So it's a great way to say, put your money where your mouth is, and let's run this out over a couple of years. Setting the table. Is the current owner replaceable? When was the last time they took vacation? Is the capital equipment well kept? These are all of those questions we ask when we say, what's transferable? So I'll include this. And then a common timeline. Confirm interest. You might need to sign a confidentiality agreement. The purchase and sale agreement really oversees it, right? There's usually two contingencies: a due diligence contingency, which you have an opportunity to inspect, and the financing contingency, where you can say, okay, I have to go finance this. And then what survives the day of close? Do you have an employee contract in place, a non-compete, or a seller note? Any questions? I just threw this out there, common due diligence items. And again, you'll get the slide deck and our contact information.